Let's turn to you. I'll ask you, Michael, the same question. Where do you see the 10-year topping out for this cycle? And then we'll get into some more sort of substantive things.
Yeah, absolutely, Todd. I mean, I think the 10-year could get to 5%. That wouldn't shock me one bit. But remember, you're earning 4.5% on the 10-year today.
Yeah.
So if you get that for the next year and you get to 5%, I mean, it's a 0% return. It's not the end of the world, right? But certainly I think you go higher from here. I mean, listen, it's funny. I was listening to Guy, to Dan, and Karen. I don't know how I can agree with all three of you when you're all saying different things, but I actually agree with all three of you. I mean, at RBA, we're pretty constructive on equities, but not tech, right? I mean, you're at the bottom of an earnings cycle, which is different than Q4 2021 when you're topping out at the earnings cycle, right? And I think that actually could argue for a broadening of, what we've seen on the Mag 7. And to Guy's point, I mean, listen, I'm a bond guy, so I was born and bred to be negative. You got lots of downside, but you don't have a lot of upside.
Kindred souls.
So we're kindred souls, all of us. But listen, I certainly think the 10-year can go up. I think that's going to have meaningful ramifications for both equities and credit. And it's going to be about how you position, I think, from here out for the next 6-12 months. It's really going to be important to be tactical.
So you're a bond guy, but from what you're saying, if interest rates are going to keep moving up like that, it's going to be a hard sled for equities.
It certainly will be a hard sled for certain equities. Remember, why bond yields go up is important. Mm-hmm. If they're going up because growth is accelerating, right, that should be good for your more traditional cyclical sectors. Energy, materials, industrials, financials, for example. And listen, the yield curve is about as inverted that it's been in 40 some odd years. If that were to steepen a little bit, that could certainly be good for banks, right? So I think it depends. It's not totally clear cut, but it certainly isn't good for high valuation growth.
What was it? I mean, people were saying this was a hawkish pause or a pawkish pause or whatever it was. Yes, what was it in either the messaging or the action of the Fed? And Karen and I talked about it a little beforehand, and I'll see if you answer it the same way. What was it about what happened yesterday that caused the market reaction in equities today to be as violently down as it is? It was tonally different, I suppose, but there wasn't a huge fierceness there.
I agree, Tyler. I mean, when we look at, the press conference, the fact that they paused, et cetera, is very much in line with expectations. I think the big surprise was removing a couple cuts next year.
Bang, that's what Karen said.
And that ultimately, I mean, I think Karen's absolutely right then, because that's ultimately what was the surprise to the market. And I would argue it shouldn't be a surprise. I mean, Chair Powell's been telling you higher for longer for 18 months. The market just didn't believe him. And I think the combination of the economic projections plus some of the stronger data we've seen more recently, whether that be in inflation or some of the other strength in manufacturing and other areas of the economy, finally got the market to wake up that maybe you aren't going to see 150 or 125 basis points of cuts next year. Yeah,
that was the thing you mentioned right off the top. It was this idea that 2 interest rate cuts are off the table, apparently.
At the moment.
At the moment.
Right. They could go back on. Ironically, we would need some really weaker economic data, so I guess bad is good. Although when you get into a certain tape, bad's bad, like Guy said. That's Guy's view of the world. Bad's bad, good's bad, it's all bad. But I think, I do think a little bit.
And that's the good news.
Yeah, there we go. And a little cooler data would be good. I also think that it's the rate of change. This move in the bond market has been so fierce, such a big move. Guy always talks about it all the time. We didn't used to see these moves like this. Something's broken here. And I think if we were to get to a level and stabilize it, even if it's 5, but if we sat there for a while, I think the market would get used to that. But here we're like, wow, that we could blow through that in 3 days, the rate we're going.
Something's broken, you just said. What is it?
Well, Guy's the master of something broken.
So this we mentioned before, it's the United States.
Yeah.
It's still the largest economy in the history of mankind. I think that's fair, right? Mm-hmm. When you see a 13 basis point move, and by the way, this is not just today. I mean, over the last 18 months, 2 years, you see typically 10, 15 basis point move in things that shouldn't trade that way. And I've said this, I'll say it again for new viewers. Hopefully you're watching and enjoying the show in the first 10 minutes. The U.S. Treasury market trades like a $100 million biotech stock with one drug in the pipeline. It shouldn't be that volatile. It should not be that volatile. Bond market is broken. And the Fed thinks they can control it. And Rick, I can't wait for him to come on because he's going to sort of be so on board. They think that they have zero control. The same way they thought they could control inflation Guess what? They couldn't. And the same way they think they can control the unemployment rate, which, by the way, is going higher. California, I think, is north of 4.5%. They typically lead the United States by a couple months. They think they can somehow stop it when they want to. They won't be able to. So they created the problem they're trying to fix, and they're just going to create another problem on the back.